Hi everyone, and welcome back to my channel. Today we're going to talk about how to choose an ETF for Americans and Europeans. Because most of the time when we start investing and the first kind of approach we have is to go into some kind of safe investing like a passive ETF. But even in this case, most people are kind of left blind to understand what is exactly a good ETF to look for and what are the attributes that this ETF should have and what is even exactly like an ETF, what is structure, how is it structured and why. Also because there are more than 3000 ETF out there and it's difficult to choose from where to pick. So we're gonna start to look at what's an ETF, how are they created, where and what to research, and the most important attributes that these need to have, and what you should look for your personal choice. So first of all, what's an ETF? ETF stands for Exchange Traded Fund, and it's basically a basket of different stocks. Why is an ETF created? Basically, so let's suppose that you have a single stock, like for example Amazon. If Amazon goes down 1% today, you lose 1% today. If Amazon goes down 10% today, you lose 10%. So when you own single stock, you are exposed to a very high market volatility. Let's just imagine owning Tesla that sometimes does swings of 7% a day. It can be very risky for your portfolio. Of course, if you don't, you also can have the argument that this might go up higher, but for some people it's much easier to have something less volatile because they feel much safer. So an ETF, it's a combination of more stocks, because if one of your stock goes down, there are many other stocks in your ETF that balances this out and go up. So let's, for example, have an ETF of 3 stocks, of Starbucks, GameStop and Amazon. If Amazon goes down 1%, this is balanced out anyway by GameStop that goes up 1%. And then Starbucks goes up 3%. And since Starbucks is 1/3 of the ETF, you divide 3% by 3, you get that the whole ETF goes up 1%. So you see, in this way you balance out your risk, your ETF still grows, some companies are down, but your ETF still grows. This is a kind of called passive strategy, and in this way you can manage to have some kind of good return per year. So like in this way you get good return per year. Of course you don't get high return as volatile stocks, but at the same time you don't get high losses as volatile stocks. So on the long term, this is a strategy that pay off quite well. So let's say now, what is exactly, like, we understood what is exactly an ETF, but how is it created? Basically, behind an ETF there are always like big financial institutions that create indices. And these financial institutions, you know them quite well, are like Bloomberg, JP Morgan, MSCI, FTSE, S&P Standard & Poor's. And these companies create indices like, for example, the S&P 500, which is the most famous index in the world that tracks the 500 biggest companies in the US. Now, what happens when somebody wants to invest in the S&P 500? Since these are existing indexes, you cannot invest in something like that. You have to invest on an ETF tracker, so an ETF that tracks these indexes. And who creates this ETF? The ETF are created by another financial institution like BlackRock, Vanguard and Fidelity. And this ETF then tracks the existing indices. Of course, then this ETF needs to be traded in exchanges where you buy with your broker. So the logic is that big financial institutions create indexes, other big financial institutions create ETF that track the previous indexes. They provide them to exchanges from where you can buy. So now that we know that these ETF are basically existing to track something, how do we look for this ETF and where do we look? Like, first of all, I like always to use justetf.com or etf.com as a good platform to research ETF. This might vary if you are a resident in the US or in Europe, because, for example, Europeans are not allowed to trade US ETFs. And so, for example, if you're European, you cannot invest on ARK Invest ETF, unfortunately. But if you're in the US, of course, you can, and you can use the website etf.com. So now, once that you choose the platform, you have to choose the asset class. So what's the product that you want to invest on? Because an ETF can be created out of everything, like only precious metals or only real estate or only bonds. So once you choose what you want to invest in, you have to choose like a kind of category. So now you know that you want an ETF on stocks, but which kind of stocks? Like stocks can be related to anything, because if I want, I can create an ETF of an index that tracks company that start only with the letter R. So you have to choose what category you want. So you want a region or a country or a sector, or track an existing index or an equity. So once you choose this kind of category, then you can go to your broker and check if your broker has one of these ETF that you found. What are important attributes to look at when you want to choose between different ETF? Because you might go back here and say, okay, I wanted an ETF that tracks the oil sector, but I end up having like 10 of these ETF available. What are the attributes that would make me say which one is better? So first of all, we have to look at the total expense ratio. So an ETF is a passive investing, yes, but it doesn't mean that it's free. So every time you have a share of an ETF, every year you have to pay a kind of a percentage to the provider of the ETF, so BlackRock, Vanguard, Fidelity. And this expense ratio usually it's quite a small percentage, but this can influence a lot your total return over time. So an ETF usually has a good ETF usually has a TER of 0.1%, but this can grow even to 0.5 or even 1% sometimes, and then you have to be careful that the percentage isn't too high for that would be like much more cost for you. Some of my favorite ETF have even 0.65% of expense ratio. I keep them anyway because the return that they give is much higher than the usual market. But if you want an ETF of the S&P 500, usually your expense ratio shouldn't pass 0.2% to be like a good ETF. Then you have to check the performance. So like you have 10 different ETF, how did they perform in the last year? Because yeah, all ETF are tracking the S&P 500, but remember, these are just replicating the existing index of the S&P 500. So the provider has to buy companies that emulate what is in the S&P 500 and change them over time to replicate the same performance. So some ETF might be better at replicating the S&P 500, some ETF might be worse. So you have to check the performance over the last 3 years, 1 year, 3 months, 1 month. And then of course the time since inception. You don't want to invest on something that was created 2 weeks ago or like 3 months ago. Maybe something that has like a long track record and lots of information. It's much safer to invest on, especially if we think about that this is kind of safe investing. Okay, last thing, very important thing to look for an ETF is if it's like a cumulative type or distributive type. So whenever you have an ETF, there is a high chance that some of the stocks inside those ETF give dividends. We will discuss in another video what are dividends, but basically, long story short, it's just that some money that are part of the earnings of the company that are like given to the shareholders. So let's say you have an ETF in which one of these company pay dividend, you will receive this dividend. Now, the moment you receive a dividend in your account, this is a kind of a taxable operation. So it's like kind of money that you received as a salary. So it's very important that you decide which kind of strategy you want to take when you buy an ETF that gives dividend, because you have either a cumulative type or distributive type. In the accumulative type, the dividend that the ETF pays to you are directly used to repurchase new shares. So the dividend is never really deposited in your account, it's just used to buy new shares. This means that those money you never really receive them in your account, so they are not really taxable at that moment. So this can vary country to country, but technically those money are not taxed, so it means this is a more tax efficient way. So you receive €100 of dividend every year. These €100 are used right away to buy new shares of that ETF. In the distributive case, the dividend are instead distributed in your account. So you receive the €100, $100 in your account, and this has to be taxed in the next year because this is like kind of salary money that you received. So you have to pay your kind of taxation, which is 15 or 25%, depends on the country where you live. So you have to decide now. You want to receive a kind of a passive income per year, then go through a distributive ETF that pays you every quarter, every month, or every year a kind of salary. you want instead to keep growing and accumulating the shares because you feel like it's better, it's a much more proliferant strategy in the future, then choose an accumulative ETF that use the dividend to buy shares, and this way you will not even have to worry about taxes for the time being. So with that said, I think we can take a look at one of these two platforms and do like a kind of screener on the first time and see how this works. Okay, so here we are in just ETF.com. So as you can see, you can set up here, for example, the country in which you're domiciled. So it's going to give you ETF for that particular country. This is, remember, only for Europeans. If you want to you are a resident in the US or somewhere else, then you can use ETF.com. And here you have like a screener for people that are resident in the US or in other countries. So let's take just ETF.com. I really like this website. We go to ETF screener, and as we said, we have to look first of all at the type of asset we want to buy, the type of product. You have here all asset classes, so you can choose between indices. So you can go here, for example, and say, okay, I want something that emulates the MSCI World. So you go until you find the MSCI World. Takes a bit. Here we go. And you see there are lots of ETF, and the MSCI World is coming soon. Here we go, here. So you select this one and it's gonna give you all the MSCI World that are available at that moment. Other thing would be that you select, for example, an ETF by region. So region means like Eastern Europe, emerging markets, Latin America, or by country directly. So we're gonna toggle this off. For example, I would like to choose an ETF based on sector, and sector that is very interesting at the moment is energy. So we go with energy. And you can even screen this more by select, for example, a theme in energy that could be clean energy. And now you end up having 3 ETFs. So one is issued by iShares, BlackRock, one is issued by Elixir, and one is issued by LNG. So you have 3 ETF, you have now to choose which one is better. First of all, you have to look which type of ETF are these, like the type of cost. So we have that the total expense ratio, it's quite okay, a bit high, I would say, but these are ETF that grow in 1 year over 100%. So I would say this is a kind of cost that you can afford for this type of ETF. Of course, if you look at the past year performance, you see that this one beat Elixir by quite a margin, and this one didn't have any performance because probably was not issued in the last year. So if you look at periods here, you see that this one is kind of 1 month old. These other two are at least 3 years old, but the iShares beat the Elixir by 2.5%. So if you had invested in iShares instead of Elixir ETF, you would have got 2.5 more money after 3 years. Okay. From here it looks like iShare Global Clean Energy looks like the better ETF, but we have also to see if these 3 ETF are available in your broker. So what we have to do is to go to Saving Plan ETF, for example, and for example, since I selected Germany, it's gonna give me all the brokers that are available in Germany for this ETF. And you see that, for example, if I want to choose DKB, which is a very important German bank, you won't have anymore the LNG, but only iShare and Elixir. And if I choose another popular one like Trade Republic, then you see that you only have iShare Clean Energy. So at the end of the day, you have only Trade Republic, you can buy only this ETF for clean energy. But anyway, even if you had DKB in this particular case, I would have said that iShare was the better ETF because of both costs and both performance. We can then select something else, for example, like an indices, like the still selected the broker. We can select now the most famous index, which is the S&P 500, and see. So from Standard & Poor's, S&P 500, here we go. Here we have a lot of ETFs, like 19. Again, we screen based on the current platform that we use. Let's say we take Trade Republic again, which is one of the most famous broker in Germany and Austria. And now you see that you have 2 iShares in both cases. All of them have kind of similar performance. the TER is the same. There is a difference in fund size. Why? Because one, as you see, is ACC, a cumulative ETF. The one is distributive. And you see that people went more in the kind of a cumulative ETF. So here is again a choice that you want, that depends on you. You want dividend to be deposited in your account and use it as a passive income, or you want dividend to be used to repurchase your the shares. So I prefer usually the accumulative ETF for the long term. So this is the kind of ETF I will take. Now I also would like to see what are the companies that are inside this ETF. So I know that the S&P 500 are the 500 largest US stocks, but if you select this fact sheet EN, then you have like a kind of a PDF information about the ticker symbol, the company, the kind of technical data that goes until the performance data that goes until 2010, some key information here. You should have also your kind of dividend percentage. Maybe we'll look at it later. Here are the top holdings: Apple, Microsoft, Facebook, Tesla, Google, Johnson & Johnson, JP Morgan. Past performances, the fund with the benchmark. And then we have the sector breakdown. And the sector breakdown, it tells us that we're more, of course, exposed to tech, as it should be, healthcare, consumer, and where to buy this, for example, in Europe. So you have both Xetra and the London Stock Exchange. So you see, you have kind of many information that you can take and use here, and it's good to also have a look at top holdings and performance to see what exactly you're investing in, because sometimes people tend to see high dividend and then they look at the top holdings and they are crap. So I would take a look at this, and it's actually quite compact, easy to download, so it's quite good. Here of course there are many more information if you want to take a look at it, and I would say it's quite extensive. And for a first beginner it's not so difficult to go through. We can of course always switch to another country like France, for example. So with that being said, see you guys in the next video, and I hope you appreciate it. Leave a thumbs up and consider to subscribe.